Good morning. It's Wednesday, October 1st. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So we got the MLB playoffs. We also got a new notebook. So what I do is I'll close out the September one, file that one in one of the trunks here, start off with the brand new October one. So I suggest that you guys do the same thing. Kind of I can go back and look and see what the ideas that worked, what things did not work, what things I can adjust, and then what different factors were I looking at as far as modeling some of these markets here, and what really was important, because at certain points of time on this particular program, we're trying to track what are the most important things that are driving the precious metals rally, whether or not it's rising inflation, increasing probabilities of Fed interest rate cuts, what are the ETF flows, and what are just mainly the drivers of each individual market, as each commodity market has some separate but different but also similar sets of drivers. Much of it is supply and demand. Now, when you look at the precious metals markets, it's a bit more of the economic data that is the front runner, then supply and demand does play a role in those markets. So what we're looking at here in the silver market today is the massive ETF flows that have come in. About 6 million ounces of silver yesterday, and that really reversed those 3 days of outflows. ETF flows have been one of the main drivers of the metals markets here just recently, with a widespread adoption of incorporating some of these precious metals into your particular portfolios. Now, we do have gold at a new record high. And what are the risks to the rally in the gold market? That's something that I want to address. Usually when it comes to the last day of the month, beyond doing a lot of catching up and things like that and closing out the books on the month, what I'll do is I'll look at the markets that have done quite well or the markets that have underperformed and see and identify different opportunities there, and identify also what are the risks to derail a particular market without using any kind of bias to it, saying that valuations and feelings and things like that are just, it's too high. Because the reality is if you look at the gold market, I see a lot of enthusiasm behind that. I see a lot of enthusiasm behind the silver market. And then when we talk about the S&P 500, the NASDAQ, the Russell, or whatever, or individual stocks, people bring out their feelings and their biases that these markets are too overbought, too stretched, and things like that. But I don't hear that from individuals when we talk about the metals market. So that's where those feelings come into play, and we really want to keep those feelings checked and aside. And that's where I go from a very non-biased, non-feeling, objective approach of what are driving these factors in these markets, what changes to the drivers here, and then what kind of impact does it have. So I'll get into that just briefly and quickly at the end of this video. So today, the only thing you're going to hear about is a government shutdown. If Bloomberg didn't have the data on the side of this particular screen, that TV would be off too, because the reality is that what they're trying to sell you in the media is that it's fear. And what we saw the last month, what did we see when we came into September? They said it was seasonality. What did they say when we came into August? You get into July 31st, the August move, that was a 2-day sell-off. They said that the bull market had run out of steam, that the summer melt-up is completely over. Then you go to August 29th and September 2nd. They said that September is the worst month in history. And I did an entire video breaking that down and saying that, and challenging that particular thesis there as far as the sell-off in the seasonality in September, and that while it's very important when it comes to history to be aware of history, it's even more important not to become trapped by the history. That's why you want to look forward. You want to adapt. You don't dwell on this past year. That's where depression starts to set in. You need to be optimistic in looking forward at all points in times here and take things objectively. You go back into, speaking of history, 2018, 2019, it was a 34-day government shutdown. What did gold do during that period of time? Well, I pulled up my notebook, and gold only rallied $20 over that point in time, $12.60 to $12.80. Now, the way that the economic data and the way that the cycle was playing out, it already had some tailwinds for the gold market, and gold continued to march on higher. But the reality is that the government shutdown played very little role in the gold market whatsoever. You look at the S&P 500, historically, it has emerged unscathed since prior shutdowns. Yes, you get these sell-offs like what we're seeing right now, but again, there's no continuation of it because of the fact that you have to look at where the economy is, where the flows are, what is going on as far as the Fed, bigger policies in the global economy. So again, if you stay to the end, I'll quickly go over the potential risks to the gold market and my personal checklist that I'll be watching for. So let's check it on the setup, the US equity markets, the precious metals. So futures, they are starting October in the red as the first government shutdown in nearly 7 years triggers what? People's emotions, and they sell off. We also talked about yesterday, we had that big sell-off in the metals markets. What was that? That was profit taking. And then what occurred after that? We saw a V-shaped recovery, and it was in many markets out there because that's called marking up your book. That's called showing that you own those assets on the particular books. So that's what we saw was that month-end markup, and that pushed it all higher. Now, much of this U.S. equity sell-off, maybe potentially some of it is driven by the sell-off because of the government shutdown, but the reality is that a lot of these fund managers, a lot of these money managers that had missed out on the US equity rally wanted to show that they were positioned in there, so they buy it and chase it up and at the close. And what do? They quickly liquidated it just shortly after, and they go back into their delta neutral or whatever strategy that they're implementing. So the dollar, that is slightly reversing its 4-day losing streak here. You do have gold futures rising to a new all-time high here. The December gold futures, $39.2270. It's up about 1%. That's $42. They actually came out, I did a media spot on Yahoo Finance yesterday, and they said, could gold hit $4,000 in 2026? And I laughed at the commentator because of the fact that he must be unaware that the average true range on gold is about $55 an ounce here per day, meaning that it could, in 2 days, you could hit $4,000. All it needs is two standard, nothing out of the ordinary, because $55 is what it's moving a day. 55, we're over 4,000. So what I'll do is I'll look at, on the metals edge, I'll look at what the tactical resistance levels are and support levels are. And what that does is it takes into account volatility, volume, and price action here. And it'll tell me what is a normal, what is an extended potential rally on these particular markets and where we could get to on these particular markets. So if I look here today and I look at the gold market, it says that 4,004 is the upper end on a tactical resistance 3, meaning that yes, there's a high degree of probability that we could get over $4,000. I'll look at the silver market. What is tactical resistance 3? $49.22. So not quite there yet for the $50 for the people that are calling for $50. What my model shows is that the reality is that $49.22 is probably about all we got here for the moment here on today's price action. So that gets a bit into some of the other models that we run over here. Now, if you look at this impasse in Washington, what it's important is to me as a trader is that the non-farm payroll data release may not be released. I am a very data-driven person here. And then you look at the ADP employment numbers, that might give you some more attention if that is released, which it should be here this morning. So the S&P 500 futures down about 0.5%, NASDAQ down just a little bit more than 0.5%. The Russell actually outperforming all of them, down just under 0.5%. So that's where the action is at here. And I believe that the Russell will continue to see dip buyers come in as AI adoption helps fuel organic growth in smaller businesses. Now, if you look at the checklist on the health of the market, you do have the dollar index. The suspension of federal operation does risk adding some further pressure on the dollar, but it's going to be the release of the data and the health check of the U.S. economy that we're going to be missing out on. Now, if you look at 10-year Treasury yields, they're rising just a bit. We saw them get slammed earlier yesterday. You go to the cash VIX, little bit higher here. It shows up about 1.5%, but it really hasn't broken out over any key levels whatsoever here. And you look at the current economic environment, well, it really shows stagflation still going on at the market here. You look at the euro currency, 57.6% inverse correlation to the dollar. We saw euro area inflation accelerate in September. Consumer price index rose 2.2% from a year ago. It was really the energy base effects, the service costs that are coming in. So we want to pay attention to that as well, because it'll play a role on the dollar index, which will play a role on the gold market, which will play a role on 10-year treasuries. So you go through these checklists here, you're looking at offense, defense, special teams, the coaching, everything else. What is our preparation work that's coming into play? You go across the pond here, you start looking at Europe, you look at Asia with a large cap European stock. The Stoxx 50 index rose as much as 0.3%, setting a new fresh record close for the first time since March. So that was a big move up for that, and that's a meaningful move. You look at Asian stocks, they were pulled lower here by declines in Japanese shares, concerns over the impact of the US government shutdown, but you do have Hong Kong and you have Chinese markets that are shut for holidays. That was potentially part of that sell-off that we saw in the precious metals markets, and I talked about that yesterday. You start to look at the economic data coming out. We all have ADP change for September. You also have the S&P Global US Manufacturing PMI data. You're going to have a couple Fed speakers come out here as well. And then what we'll want to do is we'll think about how does this impact future interest rate cuts and how long will this government shutdown last? Well, Polymarket gives it a 3% chance that they settle this thing out by the end of the week. You go out to 15 days or more. So you go to October 15th, they're saying a 36% chance. So people are looking for an extended government shutdown. You go to the CME's Fed Watch tool. What did this do? It pulled forward that 25 basis point interest rate cut, pushing it up to a 94.6% chance of a 25 basis point cut, 5.4% chance of no change. You go to the Poly market, that jumped up to an 85% chance of a 25 basis point interest rate cut. You start to look at some of the ETF flows that are going on. Gold up 16%. We saw ETF buys in gold, silver, platinum, palladium all yesterday. Silver gaining 1%, 15% change year to date. They added 6.11 million ounces of silver yesterday, and platinum increased 14,000 for the fifth straight day here. Actually, the sixth straight day in those ETF flows. You get the gold silver ratio sitting at 82-1. And then again, I mentioned, what are the potential risks of the gold market? I'm not bearish. I just want to know what could happen. So what I've done is I identify 4 key factors that investors should be aware of. I keep this written down on a dry erase board over here, and I go, hey, is the economic data, what economic data is coming out this week? Has the economic data that we've recently seen over the past couple weeks, has it improved? Is it better? Is it worse? Recently, we've seen better economic data. We've seen second quarter GDP, it expanded at a rate of 3.8%. We saw consumer spending, that was revised upward from 1.6 to 2.5. We saw August personal income, that rose 0.4%. And personal consumption expenditures, that exceeded expectations as well. So we have some improving economic data. All right, not saying we sell gold. I'm just telling you, we have some improving economic data. So then I look at what are the Fed interest rate cut expectations? Are they increasing or decreasing? Well, at that time when that data was coming out, remember we had one big $50 down day on the gold market. We had silver also hemorrhaging as well. So these things do play a role on each other. We saw at that point in time, we saw some dashes and some hopes go away that the Federal Reserve was going to cut that 50 basis points. That disappeared. The 25 basis points came back into play here. And then now with some new developments with the government shutdown, with the pressure on the Fed and everything else, yes, I believe that there's a firm probability that they will cut 25 basis points. But what I'll start to watch is the number of rate cuts in the terminal rate, where the terminal rate is where they stop cutting rates. That's going to be your next most important thing. So we'll want to watch that end way out there, the terminal rate. Are they taking away some interest rate cuts because of the improving economic data? Are they adding them on because we're starting to sell back off and the economic data is deteriorating? So you want to watch that. Then you want to know what is the biggest driver in the market right now, and it's the widespread adoption of precious metals into people's portfolios. Central banks were buying aggressively. Central banks have not been buying aggressively. Well, who's picked up the slack? The ETF flows. So investor enthusiasm is reflected in, you can start to look at the gold market, 16% change, silver market, 15% change in ETF holdings this year. More individuals, more institutions recognize gold and are cementing it as a position of strength in their portfolios. So what we watch is big outflows. If we would have got another 6 million troy ounces of silver outflow, today instead of an inflow reversing that trend upwards, that would be like where we'd start going, okay, we got to pay attention to these ETF outflows. We also got to pay attention to the proving economic data. Then what we do is we take it to the charts. We look at the dollar index. Is it making lower highs and lower lows or higher highs and higher lows? Then we'll look at treasury yields. What are they doing? Are they beginning to rise along with the economic data? Are they breaking out? Is it a new trend starting to take place? And then we'll look at the gold market or the silver market and go, hey, what are the key levels that we're identifying of support and resistance? Are we breaking below 37.50? Are we breaking below 36.60? So you get a number of things: improving economic data, less Fed interest rate cuts, ETF outflows, the dollar index going up, treasury yields starting to rise, gold breaking through support. Then chances are the bear market is beginning. The bull market ends, we go neutral, then we go bearish. So there's your checklist there. Again, not bearish on it. No reason to. Making a new all-time high right now. So if you guys got any questions, shoot an email to info@bluelinefutures.com. And remember, futures and option trading does involve risk of loss. May not be suitable to all investors. Good luck and good trading.